I'm Brendan Yurik, the CEO of Electric Royalties. We are a royalty company focused exclusively on those clean energy metals really required for the world to move forward into a clean energy future. We've got a portfolio of 22 royalties to date. Two of them are producing, and all of our royalties are in good jurisdictions, primarily targeting those deposits in North America, Europe, and Australia that could fit the bill to be a domestic source supply of these metals moving forward. Over 400 million has been raised in the last 2-3 years here since we've acquired them. That's all going to our assets, developing them at no cost to us, and it should be an exciting year. We've got a lot of catalysts coming across the board, and we're going to be actively looking to acquire more producing royalties.
Brendan, good to see you. Just want to catch up with you. Also, it's been a kind of tumultuous environment out there for equities, but for royalty companies, it's more of a waiting game, isn't it, at the moment? And my question to you is, what do you do in periods like this? Shouldn't you be out like buying stuff?
Yeah, well, it's tough because our valuations have been kicked in the teeth a little bit as well, and so that makes it obviously harder to raise money accretively. But there's some tremendous opportunities out there, and I think there's a big difference with the royalty company because we have no cost on these projects. We have no holding costs. Our G&A is very, very low, especially at our company. And so, we can just kind of wait this out. And if we were to do absolutely nothing, our portfolio is going to start generating significant cash flow in the coming years. But we see this really as an opportunity to go out and pick up royalties that otherwise might not be available. When equity prices are depressed like this, royalties are definitely a better financing option. If you look at our last deal, it was our last producing royalty deal in January, that cost us $1 million. To get done. We have an option upcoming to double that royalty interest in the next few months. And we have a facility with our largest shareholder for $3.5 million for further acquisitions. So, we definitely have some capital to pull a couple deals off. Outside of us being creative like we have in the past, bringing in a group like Sprott to co-invest alongside of us. So there's ways that we can get it done as well, but definitely a tremendous opportunity right now.
Right. And in terms of the bulk of where you've got two producers at the moment. They're not big producers, but let's not go there. The bulk of the royalties that you have, can you kind of break it down for us in terms of where the near-term revenues are going to be? Because I get the conversations that we've had in the past, and you go, well, actually, royalty companies don't have to bear those costs. You said it at the beginning. This conversation don't have to bear the cost there. We're sitting there as a sort of net benefit to us is meaningful when it comes. But surely in an environment like this, some of the development companies are slower to get into production. Are you experienced delays to your forecasts? Do you think as a result of that?
Yeah, I think there's been a couple of delays, definitely, but I think those are, as always, probably company specific. That being said, generally across our portfolio, almost all of our assets have had steady work ongoing and development ongoing. Obviously, the path to production can be a long one, but most of the assets that we targeted are, we're aiming for kind of 3 to 5 years from production. We have been when we were first getting started, and so we're seeing that happen. Our first royalty that we bought 3 years ago, our Oche lithium royalty, that's set to come into production and should be in production here over the next 12 months. They'll be the largest producing lithium mine in Canada. They're at the North American Lithium Hub. And so that'll be our third producing royalty. That's one we bought a couple of years ago. We haven't put any money into it. They've put and raised, I think it's over $250 million. And so there's an incredible growth in value there. We've also got a couple of graphite royalties, Grapmata, which is basically on care and maintenance, shut down because of COVID restrictions in the country. And they've been working to upgrade the resource, looking to actually bring that back in at double the production capacity. So that's really a question of project financing, but that could happen, as soon as that is sorted out. We also have Bishop Creek, another graphite royalty. They had a feasibility study on this, a number of years ago. Northern Graphite's now the operator, and they are becoming the third largest graphite producer outside of China. They've signed a joint venture to do a 200,000 ton per year battery plant over in Eastern Canada. And it just happens to be right next to the Bishop Creek project, which they've said they want to make their flagship asset. And so, when we initially looked at that, the feasibility study was about 28,000 tons a year. And now they're talking about 100,000 tons per year, potentially. So, that would probably be the next one in our portfolio to come in. But we have a number of different projects, whether it's our Zonia Copper project in Arizona, our Mont Sorcier iron ore vanadium project in Eastern Canada. We have a number of different ones that are fast tracking to production. Seymour Lake, another great one. They've raised over 70 million in the last year. Partnered with Lithium Americas to basically fast track Seymour Lake to production. And those lithium projects have had a much shorter development timeline than you've seen on some of the base metal side. So there's a number of ones that are kind of in that 3 to 5 year range that'll come in after that. But we're expecting our own portfolio, we could get to 5 within the next, kind of 2-3 years here. And then it really jumps up. But we're not going to be sitting on our hands. Our goal now, we have a portfolio, we have exposure to all of our target commodities. We felt like that was really important to do. So we've had to do a little bit of pain to get some of those. But we've done that, and now it's really cash flow for us. So the next number of deals that we have in our pipeline are all going to be cash flow and royalty deals till, we're trying to get to about 5 million a year in cash flow, over the next year or 2 years.
Right. Okay. And I hear what you're saying, but I guess one of the big questions people are asking is around these development companies, right? If they're loaded up with cash and they can advance things through the economic study phases, they can advance things through the all the kind of engineering and ESG type stuff that people have been talking about ad nauseum for a while now. But when it comes to the kind of CapEx component, there's a few things going on here. One, as you mentioned, inflation, COVID, supply chain issues have been a big thing over the last 2 years, but some of those prices have not come back down. They have not settled back down to 2020 prices. There's a kind of new level, therefore new sets of margins that these companies are going to have to stomach if they're going to go ahead, and their funders are going to have to stomach going ahead. How do royalty companies like yourself view, reassess the risk to those companies, reassess the near-term revenue component in that environment now? Because it's a slightly new reality, it feels like. So have you?
Yeah, well, it's to be honest, if we had more money and kind of unlimited capacity or a better valuation, there's a hell of an opportunity out there, because the way we look at it is we're getting already the best assets in our target jurisdiction. So you even look at our Sleetat tin asset in the US. It's only one of 2 assets the USGS, in their own words, say might be potentially economically viable in the United States. So on an average development timeline of 15 years, it might be 7 years from production, but it'll be the first group, to enter production. So when you look at that, and these deposits take millions of years to form, they're only found where they're found. You look at our manganese asset in North America, it's really one of a very few assets in North America. We believe the best manganese asset for the EV space in North America. And so, when you look at a project like that and you see it's only one, there's no other projects or deposits that can be magically created, to kind of fill that gap. And so I would buy them all. I would buy all the ones that are kind of, within that timeline to production if we could. So that's definitely something that there's an opportunity out there. Like I said, right now we're focused on, cash flowing assets. And that's really just about the point in time where we are as a company. We don't want to have to keep diluting shareholders as we raise capital. And so getting cash flow positive so that we don't have to do that is key for us. But there's an incredible larger opportunity, which we have been taking advantage of, for the last 3 years, investing in those types of deals. So our portfolio is going to, unlock a lot of that value for us as we move forward. From a CapEx standpoint and from an operating cost, yeah, a lot of these groups that are looking at these projects, their operating costs have gone up significantly. I wouldn't be surprised if it's 20, 30% even in some cases. And that's both on the operating and capital cost side. For us, it's kind of great because we're gross revenue royalty. We have no unit cost. They produce a pound of copper. They sell it at $3. We get, 1% of that. If a royalty is 1%, there's no cost to that. And again, we don't have to put in any of the capital costs, so we're not on the hook for that. How I think a lot of those projects are ultimately going to get done is you will see more end user participation, from the groups that really do need these metals. And I think the prices that they give will reflect what it takes to actually produce them. And so that's what I'm expecting. I think we're also expecting a higher pricing environment as we move forward.
You said something. So I've got to. Thank you for that. You said something interesting at the beginning there, which I couldn't stop thinking about. Was you saying like, in response to my question about, the CapEx component is going to restrict a lot of companies being able to actually make the decision to move forward or get funded to be able to move forward because the margins have decreased. They go from marginal projects to suboptimal projects. Are you saying that royalty companies like yourselves, because you're very much focused on the ability of the companies to get into revenue, you're able to vet the projects that you do put your money into better than others? I mean, what are you saying there?
Yeah, well, I would say it's different for this space, and we're the only royalty company focused exclusively on all these metals. We did the first graphite royalty financing ever done, second and third, tin royalty financings ever done, and so we are kind of at the forefront of this industry. But I think unlike gold, where there's a lot of gold deposits everywhere. You could throw a rock and you're going to hit one in Canada, maybe 1,000 gold deposits, but there's only one manganese asset really being developed in the EV space. There are already 3 years of metallurgy into it. And so there's it's much rarer, I would say. There's only a few of those manganese developers globally.
No, I get that. I get it. But Brendan, my question is not, how many projects are there of certain metals. My question is around your assuredness about the investments that you've made, because it's predicated on them getting to production. Otherwise, you're throwing money out the door and hoping it sticks. Why are the projects you picked more likely to succeed than other battery metal projects that you haven't picked? Because some of it's going to be you haven't been able to invest because it's competitive. Other people have beaten you to it. It's too expensive. Whatever. There's a bunch of reasons you don't invest in other things. Doesn't mean they won't get into production, but why are yours so special, and why do you feel confident that they will generate revenue at some point in the future?
Yeah, so I think generally we've done a few things to kind of de-risk that and take away some of that risk. One would be the fact that we are a royalty company, so we're diversified. There are no ongoing holding costs. So once we've made that, there's nothing else really that can go wrong with it other than they don't make it into production. I think we've done a number of things in terms of targeting these assets. Generally best in class. If we're getting best in class, that's usually a good sign, and it's really easy to compare them. We've been looking at all these assets now for 3 years. I've got 10 years of experience in project financing, analyst before that. And so I do think we have a bit of an edge in that, definitely from new investors coming into the space. I mean, it's very complicated to invest in mining. There's probably 100 things that we do look at. I think we've done a number of things as well in terms of staying away from large CapEx projects. Generally we've been picking projects where the CapEx is reasonable. Something that a junior could actually put in production. If there wasn't an end user or a partner that comes to the table, you don't have to wait for that. I think we've done a good job in terms of the jurisdictions, right? I think a lot of times, permitting can be an issue. So deciding not only to be in Canada, but to not be in BC, or to be in say Quebec, and to, kind of reduce the risk profile from a jurisdiction perspective. But like I said, there's 100 different factors that you look at this. I think we have a grading system, definitely, but comparing these projects to what else is out there and then ranking those based on where we think which ones actually will make it to production. So it's a ranking system, really. You can't really tell if one project will make it if you don't know every other project that's out there. But once you do, you can look at them and say, well, this project's, twice as good as this project. In a normal world, this project's probably going to get the green light, ahead. And so in that way, I think by comparing them and by being one of the only groups out there that's been looking at these projects for the last 4 years, I think we do have a bit of an edge.
Okay. But are you concerned about things like the increasing number the increasing amounts of CapEx required to get these things into production? Because it's like the metals prices have moved and they've bounced around, in 2022, haven't really done too much in 2023. They're still not at the sorts of levels that people would expect them to be given supply demand fundamentals for, well, pick a metal, right? Pick a metal. Are you at all concerned about the wider market, the funders? I'm talking about the people who kind of stump up. I'm talking about industry. I'm talking about the big banks coming up with the money for these companies to get into production. Because us in this space, we think it's obvious, but it's just not happening at pace.
Well, it's interesting because when I first got into the business, that very first year, basically, most of the banks, the investment banks, had their mining department shut down after that first year because they were basically lending out money to these types of projects, 100 million checks each, doing $700-800 million junior sponsored financings, and they all went bad. By and large, a lot of them went bad. So those investment bank units were basically wiped out, about 10 years ago. And I think a lot of the commercial banking and lending has been hesitant to come back into the space. I think when you look at like the nickel space is a great example. There are a lot of very large CapEx, big projects there in Canada. You look at Dumont, I think the CapEx is about $6 billion. I don't know if those projects are going to make it into production anytime soon. I think it's going to be a much longer bet for them. I think if you look at what we did, we've gone into 2 underground, development projects. CapExes are going to be relatively reasonable. There's some infrastructure already there. I think CapEx will be around 100 million versus 6 billion. And so, I think permitting will be much easier because they have a smaller footprint. So when nickel prices go, I think those are the types of projects that will make it first. You're going to need to see a sustained, much higher nickel price before banks are coming back in and lending to projects like that. Especially when you look at the kind of sways in nickel price. You look at the LME exchange and their kind of debacle. I mean, if you're talking about a project that's going to need 7-8 years to pay off the debt, probably longer there, if they have some pre-construction, but it's going to be a while, I think, before you see banks come back and lend that kind of money. The other thing is on a project that big, a lot more can go wrong. A 10% over cost is, 600 million versus 6 or, 60. So I do think it's going to be a while before we see that. Even the major miners, I can't remember the last $6 billion project they put into production. But there's very few of them, and that's because a lot of them didn't go very well.
Well, yeah, mining is a huge destroyer of value when it goes wrong, and it mostly does, and that's why we ask these questions, right? So, and again, just in the same sort of context, for you reference, you say you're not getting the value that you deserve, and we've also talked in the past about if you never spend another dime on any of these royalties that you've got, you'd still be making a lot. Still be making a lot of money, but that's not a realistic option for you in your current form, right? Because it would be quite easy for someone to come in at these levels and say just take you out into a private vehicle. It might be easy for them to come and do some M&A in the space, having those that needs it. But what are your kind of either defense mechanisms to ensure that doesn't happen, or if you do want to do it, what's your preferred option available to you? Or do you think just give it some time, guys? The market's depressed, everyone's depressed. Just give it some time, and we'll get there. I mean, what have you got available to you in terms of options?
Yeah, so I definitely think there are groups out there that would that are looking at us and would like to, maybe just take us over because our valuation is where it is. I think from a defense standpoint, it's fairly easy. Between myself and my family, who own around 14% of the company, and our largest shareholders, very much in line. He's 19.9%. We also have the initial group that we did our first deal with, Globex, that has around 8%. So just between those 3 groups, we've got, kind of 40% there, 45% up there. So we've got a very tight shareholding. No group would be able to come in and do a hostile takeover. So that's nice, to know. There are opportunities we would maybe look at that in that space. But right now our valuation, we feel is much, much lower than anybody that we try and do a deal with. And so from a, corporate M&A perspective, we're not really looking down that route. I think our goal is really, our deal flow is probably the best in the junior royalty space. We've got a lot of deal flow. We have that $3.5 million facility with our largest shareholder. It's on very, very friendly terms. And so we have some money to go get another producing royalty or two. And that should make us cash flow positive ahead of our, even our Oche lithium royalty or graphite royalties coming in production, over the next year or two. And so that's really the goal. I mean, our G&A is very low, right? If we had $1.5 million in revenue, we're basically covered off. So then we have, can afford to wait and have some of these other royalties kind of kick in, 3, 4, 5 years down the road, 2 years down the road. And so that's kind of the game plan right now. I think in terms of our funding options, definitely we're looking for a private equity group or a strategic investor who values us a little bit more appropriately than what we're seeing at these prices.
Okay. And then with regards to, okay, so I hear what you're saying there, and it's kind of difficult, even if you were doing stuff, you couldn't say anything. I do appreciate that. With regards to this $3.5 million loan facility that you've got, you've drawn down $500,000 recently. Is that for acquisitions? Is that for paying down debt? Is that for keeping the lights on? What's it for?
That's for acquisitions. So that $3.5 million is left on a $5 million facility. We don't pay any money when the money is undrawn. So that $3.5 million is sitting there. There's no cost to it sitting there. There's no interest payments on the term of the loan, which is 3 years. It's all capitalized to the end of the loan. 3 years, we felt like is the appropriate amount of time where that's a different world for us. And so, and it's our largest shareholder. It's also convertible into shares at a much higher share price. So that'd be at 50 cents a share versus where we're trading at today. And so, it's a very friendly loan. We just actually improved the terms on that when we increased it to $5 million, and that'll be used for acquisitions. We have 2 royalty options coming up on our producing royalties where we can actually double those interests this year. So we already have immediate producing royalty options that we could execute. But we're also going to be looking to add another royalty into the mix for sure.
But you want revenue producing royalties now. That would be the right mix to add to the portfolio.
Yes. And we want diversified revenues. I think what's unique about us is that our revenues right away out of the gate are going to be, if we go buy another royalty, OJ comes in production, our royalty cash flows are going to be spread out fairly evenly. And that's going to be the case, throughout our portfolio as those also come into production, which I think is unique. We're not all in on any one asset. I think, most of our assets are about equal weighting, to our success. And so even if, a project or two has a stumbles, which quite frankly, it'd be foolish not to expect, some kind of ratio for that. But we'll be okay. And so we've managed to stay diversified as we grow. And our goal right now would be to keep that going and stay diversified on our cash flows as well.
Right. And will you be giving guidance as to to revenue? I mean, because it's been a difficult market. I get it, but you've also made some statements about when you thought you'd be cash flowing, etc. in the past, and that's potentially a rob to your own back sometimes. So, how confident do you feel about being able to give guidance to the market in whatever shape form that may be, whether it be cash flow or other things?
Yeah, so it definitely a bit of a challenge because our first royalty was a joint venture with Sprott, and so there's some kind of restrictions in terms of how we report that revenue and cash flow because of the JV. And then we just got our first check, obviously, from our Panuta Tin royalty, so that'd be our second one. I think what we're doing now on our new deals that we're putting together is essentially we're trying to add in minimum payments guaranteed for the first couple of years until things get off the ground, so they kind of get started. And so in that way, and I haven't really seen too much of that for what we're doing, but that's something that, you can add it into the agreement. When you're creating a new deal, it's all negotiable. And because we do create new royalties, that's something that we're planning on doing. And in that way, we definitely would be able to give you very solid guidance, at least on the minimum side, moving forward, because it's tough to predict, sometimes when these are going to come in, exactly when they're going to be paying you, because you're not the operator, you're not in control. So that'd be the one downside of you don't have to put up any operating costs, capital costs, or do any, pay G&A to operate the mine. But at the end of the day, they are deciding, how they operate it and how they mine it.
Okay, and finally, just one last one, if you don't mind. Have we got anything to look forward to this year? Difficult market. Have you got plans?
Yes, yes, no, definitely. I mean, I think investors are going to like what we do next. Like I said, we just closed our second nickel deal. It was a development deal. I don't think the market really appreciated it. We just felt there's so few of these. We want to get some more exposure to nickel, and it was very, very cheap deal for us. So we did it. But I think investors will be pleased to hear that everything really moving forward here over the next 12 months, we're envisioning is going to be cash flow related. And we're going to be doing, kind of unique structures to get those deals done. So definitely I wouldn't sleep on us because, we're going to be aiming to hit something out of the park here over the next 6-12 months.